and the hits just keep on coming. As I speak, Amazon is down about 15 to 20% after hours. Of course, they reported their earnings tonight, and that follows Meta slash Facebook and their 24% plunge after reporting earnings last night. And then the day before, of course, was Microsoft and Alphabet. So it has been a brutal week for mega cap tech. And in tonight's presentation, I spent a lot of time talking about how there's a shift underneath the surface of the market where we're shifting more towards value investments, dividend stocks, blue chips. We're shifting away from the traditional mega cap tech that has led this market for the last decade plus. We're going to also get into some ratio analysis along with some sector analysis, of course do our traditional posture setting, and then tonight's trade application example, I wanted to focus on a bearish trade out of a software stock in the tech industry that is setting up with a bearish near-term divergence signal. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host Brandon Van Zee. It's October 27th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. You'll also find which stocks are giving you overbought and oversold cluster signals at the bottom of those emails. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. It was another exciting one in the market. And of course, it's earnings, which I must say, it feels a little bit more refreshing that we're concentrating on business operations and results as opposed to trying to, read the tea leaves of the Fed and all of that. Of course, the Fed being in a quiet period right now, and we'll certainly get back more into that commentary next week when they meet on interest rate decisions. But for now, it's all about earnings this week, and unfortunately, it's not looking so hot, especially if you are interested in mega cap tech. A couple of nights ago, we saw the meltdown of Alphabet and Microsoft. Surprisingly, the next day, the market actually held up pretty well despite that. Last night came Meta slash Facebook, and a quarter of their value was wiped off the face of the earth here in one fell swoop. And then if that wasn't enough, the hits just keep on coming. Tonight after the bell, we did hear from Amazon, and at one point, Amazon was down 20% after hours. They have slowly recovered, so they hit a low of around $88 or $87 after hours, after closing at around 111 in the normal session. As we speak here in real time, a couple of hours after the session is over, in after hours, we're trading at about 95 now on Amazon. So it has recovered off of those initial lows down to 87, but still, this thing opens up at $95 tomorrow. That's going to be a significant haircut there from a market cap perspective. Some of you might have seen my tweet that I posted here just a moment ago when Amazon was initially down 20% right after their earnings release. I went back because I was thinking to myself, man, that seems like a lot. I don't recall Amazon having that bad of damage after earnings before. And I went back and looked, and it was actually all the way back in 2006 was the last time that Amazon was down more than 20% in a day, back in July of 2026 when it was down about 21%. I was somewhat surprised that not even during the great financial crisis of 08-09 or in the COVID wipeout period of March of 2020, none of those days did Amazon go down 20% in a single day. So this is a pretty astonishing result that we're witnessing after hours here tonight. But again, we're on a little bit of a recovery here from 87 up to 95. So who knows, maybe by tomorrow morning, cooler heads will prevail and maybe it won't be nearly as damaging as it initially looked. Apple also came out here this evening, And of all the big cap tech companies so far this week, Apple is the one that had the most muted response. It's actually just trading break even right now. And compared to, the major losses at Alphabet and Microsoft and Meta and Amazon, and a break-even performance out of Apple looks like a huge win comparatively. So tomorrow shall be another interesting day in the market. And right now, leaning a little bit more bearish as we head into tomorrow's open because of the importance of Amazon and also to a degree Apple. So that's after hours here this evening. Let's talk about what actually happened in the normal session today. And one thing that you might recognize when you look at this heat map of the S&P 500 is that what stands out is the fact that the big squares and rectangles are basically the ones in the red, but most of the small squares and rectangles are actually in the green. And we'll talk about this here in just a little bit with the overall market breadth. But we actually had more stocks closing higher today than lower, even though the S&P 500 was down by more than 0.5%. And you don't see that very often. And the reason that it happened is because the S&P 500 is a market cap weighted index. And so stocks like Apple, Microsoft, Amazon, Alphabet, and Meta are all much more influential than the puny little companies out there. Something like Rockwell Automation. I think this company actually announced a dividend increase today, so that one caught my eye. But it's a $28 billion company. You compare that to Apple, which is a $2 trillion company, and Apple is factors more important than something like that. So while it's great to see all this green here, unfortunately, it just doesn't offset the importance of those mega cap players here. And for many years, it was the mega cap players that were kind of pulling the market up with them. Now it almost feels a little bit like the opposite, at least this week, where the mega cap players are nosediving and it's all the small players that are kind of retaining their value. So in the normal session, Apple was down 3%, and again, they're about break even after hours after reporting their earnings. Amazon in the normal session today was down 4%, and currently after hours, they're down about an additional 15% on top of that 4% loss in the normal session. Alphabet was down about 2% today, and of course we talked about this on Tuesday when I was last with you. They've really struggled and have broken down well below 100. They hit new 52-week lows today, right? The market again held in there okay. We're still trading above the 30-day moving average on a lot of the indices in the United States, yet very important companies like Alphabet are hitting fresh 52-week lows as we speak. And then Meta surely shows up in the bright red down below, and there is the evidence, and it's grisly, down 24.56% today, a quarter of the value gone. One thing I heard on business television earlier today is that Meta has lost $800 billion in market cap this year. In other words, they were once a $1 trillion company that is now only about a quarter of that at around $260 billion. So, it's remarkable to see the meltdown there. To put that into comparison, the $800 billion of market cap that was lost at Meta, the old Facebook, Tesla, which of course is an extraordinary success from a stock perspective here in recent years, is worth $710 billion today. So Meta has lost an entire Tesla in market cap just this year, which is extraordinary to think about. And even when you look at this heat map, I've been looking at this heat map with you guys for quite a long time, and I imagine if you went back and looked at the heat map at the beginning of the year, Meta's box was much bigger than what you see right now. It kind of feels like the ever-shrinking rectangle here, because it's becoming less and less important and less influential on the S&P 500, the smaller that its market cap gets. And since it used to be a $1 trillion company, it used to be 4 times more important than it is today. So it is rather remarkable to see that take place in such a small amount of time. And a lot of people, of course, are waving their fingers directly at Mark Zuckerberg and his decision to pivot the company towards the metaverse and going as far as changing the company's name from Facebook to Meta Platforms and changing the ticker symbol from FB to Meta. And this could very well go down as one of the worst corporate pivots in history if it does not prove to be fruitful. And right now there's not really any evidence that it will be. So it's going to be really interesting to see how that shakes out, because I think sometimes people forget companies do come and go, and important ones at that. Just a couple decades ago, Yahoo used to be a very, very important company, and today it's basically a shadow of its former self. Is it possible that Meta Platforms, once one of the 5 largest companies in the United States, is basically just going to wither away as history, goes on? So very interesting to watch capitalism and its creative destruction that it creates along the way. So with all of that negativity out of the way, let's talk about some of the areas that were more of the bright spots out there. We did have some bright spots there in the industrial space. I see Caterpillar, one of the dividend aristocrats, up 7% today, one of the better performers out there. Boeing had a snapback. They did quite poorly a little bit earlier in the week when they reported their earnings, so they snapped back by 4% today. And then a lot of those same aerospace and defense companies, stop me if you've heard this before, of course just joking there because I've been like a broken clock talking about it more times than not this calendar year, where one of the few bright spots of the market this year has been the defense contractors. And here we go again, Raytheon up 1.4%. Lockheed Martin up 2%, General Dynamics up 1%, L3 Harris up 1%, and even Northrop Grumman almost finished up 1%. And that one really caught my eye today because earlier in the session it was down significantly. I think they had an earnings release themselves, and initially investors sold it off. So for them to battle all the way back and basically close at new 52-week highs was a rather impressive turnaround on an intraday basis there for Northrop Grumman. So the industrials seem to have some life here today. Seem like the financials more so were kind of on the positive side of the equation as well. Seemed like we had a little bit more green there in kind of the energy area, although it's a little bit of a split difference there. Some of the bigger players like Exxon and Chevron closed green, but then Conoco was kind of flat. We did have, the consumer discretionary stocks do reasonably well. McDonald's, another aristocrat there, leading the way higher, up 3%. On the flip side of that, we did see that Nike struggled today, down about 2%. But some of these other retailing companies like Home Depot and O'Reilly and TJX, they all closed in the green. So, it was a mixed bag type of a day. But I think the takeaway, the summary was, it was a day that very clearly defined the mega caps from everybody else, and the mega caps truly struggled, whereas a lot of the smaller players in the market held up their end of the bargain. So in a way, the market's resiliency has been somewhat impressive in light of the earnings reports that we've seen this week. Nonetheless, it makes you wonder, how far can the market go with its bullishness here currently if it doesn't have the most important players on board for the ride? And the chances of that happening, at least in my opinion, are pretty slim, sadly. Wish that wasn't the case, but I can't envision that personally. And so I still think we are in a quite precarious market here right now, despite a tip of the hat to the resiliency of the market that we've witnessed so far this week. Let's go ahead and take a look at the specific breadth numbers now. And as you can see, 279 out of the S&P 500 stocks did close in the green today. So again, kind of a weird day where 55% of the stocks in the market closed up. 45% of the stocks closed down. Yet the stock market was down over 0.5% today. And the reason for that, reason for that, of course, is those mega caps that I'd mentioned before. They have more sway over the overall performance of the S&P 500 due to its market cap weighting mechanism that it has. If we were to pop now on over here to the charts, I did also want to point out the opposite of market cap weighted, which is price weighted. Many of you are aware that the Dow Jones Industrial Average is a little bit of a strange animal in that it is a price-weighted index. It does not weight its components by its market cap. So a stock like Apple doesn't necessarily have to be the most influential component of the Dow, even though Apple is in it. Apple is the most influential member of the S&P 500, and I'm sure the NASDAQ as well. But in the Dow, it would really depend upon what the market cap, or I'm sorry, what the prices were. I guess we could figure that out pretty quickly here by just coming over to the quotes tab, and let's come down here to the public. And in the public watch list, you should be able to find the Dow Jones Industrial Average. And if we just simply sort this by price, you can see that United Healthcare is actually the most important stock in the Dow Jones Industrial Average, followed by Goldman, followed by Home Depot, followed by Amgen, followed by McDonald's, followed by Microsoft, Caterpillar, Visa, Honeywell, Chevron, Travelers, Johnson & Johnson, Salesforce, American Express, and then finally Apple. Apple is basically directly in the middle of the Dow Jones Industrial Average in terms of its importance. So a stock like American Express, which is worth only $100 billion, is technically more influential on the Dow's total return than Apple is. And to take that point a step further, up here you'll see Travelers is only a $41 billion company, but because its price per share is higher than Apple's, Travelers, a company that is a fraction of the market cap of Apple, is actually more influential on the Dow than Apple is. So that is part of the reason why the Dow has been able to go on this really impressive run in the last 5 days. We're up 5 straight days on the Dow. And the type of outperformance that the Dow is seeing versus something like the NASDAQ is probably something that would take you back, many years, if not decades, in terms of this type of outperformance, because we are basically sitting at a time where the mega cap tech companies are getting smoked on the NASDAQ, yet the old school Dow players have been just grinding their way higher for 5 days in a row. So very interesting market that we find ourselves in the middle of here all of a sudden. So Dow was actually up today. Yes, you heard that right. The Dow was up 0.61% today, even though the S&P 500 was down 0.61% today, and the NASDAQ was down 1.63% today. The Russell 2000, like the Dow, was actually up today, but only by 0.11. So once again, here's the Dow Jones as our leader today. And I've said that many times in the last few weeks. Right? We talked about that as far back as this important candle right here on October 13th, and talked about how the Dow was the one that likely was the one that would provide the bullish leadership to the upside if we were to have somewhat of a reasonable stock market in front of us. And that's exactly what has happened. And the reason I made that claim back then is because it was the one that was the closest to the moving average even at that point, because these other candles on the S&P 500 and on the NASDAQ down below still had a huge gap between their moving averages. So we knew in advance that there was a high likelihood that the Dow would be the leader, and that's exactly what has happened here. What we didn't know for sure is whether the market would go up. So that was really the bigger question. But we were feeling fairly confident that if the market went up, it would be the Dow that would lead the way. And that's exactly what has basically unfolded right before our eyes here in the last 2 or 3 weeks. So no surprise that after having that leadership, we recognize that the Dow has the strongly bullish posture. That's that dark green shading background color there. And joining them, the Dow has had that for the last 4 days. Notice the crossover of the light green right here to the dark green right here. So it's basically been 4 days now that the Dow has had the strongly bullish posture. But yesterday, we did see the Dow get joined by the S&P 500 with that strongly bullish posture, and it retains it today despite the S&P 500 actually being down the last 2 days, right? The Dow's been up 2 days in a row, so that's not a surprise that it's retained its strongly bullish posture, but maybe a little bit more surprising that the S&P 500 has been able to cling to that posture despite being down the last 2 days. And then the Russell 2000 doesn't want to be left out of the fun. Today, it switches from the weekly bullish posture to the strongly bullish posture here, as that green intermediate line has crossed up and through the indicator's midpoint. So that means that the odd man out in this conversation right now is the NASDAQ composite. It remains with that weekly bullish posture with that light green background color there, and I think it is well deserved. You can see right here that 2 days ago the NASDAQ topped out. Then we heard from Google and Microsoft after the bell on Tuesday, and then yesterday we heard from Meta after the bell, and then tonight we're hearing from Amazon and Apple after the bell. So there's a pretty decent chance that the NASDAQ will roll over yet again tomorrow, and we could see this green line fall. Tomorrow it might be a little bit tricky for it to do it because it's got a little bit of momentum behind it. But I would say that there is a pretty reasonable chance that early next week, the NASDAQ composites posture will go back to bearish. And remember, it won't go to weekly bearish. It'll go straight to strongly bearish, this darker shade of pink, because this green line has not yet crossed above the 50th percentile of the indicator. It's only at 45 right now. So assuming it doesn't coast too far, and assuming that tonight's after hours activity holds, again, with Amazon down so much, the Qs I'm sure are getting hit. So let me just pull up QQQ. And you can see that the Qs are down a couple of bucks. It's not as bad, right? Right after Amazon reported, you can see the Qs went all the way down to 265 in the after-hours session, and they closed tonight at 272. So that was a pretty healthy haircut there. But they have started that recovery just a little bit, as Amazon itself has recovered just a little bit after hours. It's hard to see this right here. I think these are some glitch candles. They weren't legitimate, but this one was. This print of 87.59 was the true low of Amazon after hours, and they've gone from 87 back up here to 96. So while they'll still be down tremendously from where the close is, they're well off of the after hours lows right now. So I think that's kind of helped the Qs just a little bit. Nonetheless, at this moment in time, it appears like the Qs will likely be lower tomorrow, and you can already see it's not looking all that promising on the chart for the NASDAQ composite. If I were to right click and maximize this, you get the impression that this is a rolling over effect that's taking place here. And that kind of will lead into my trade application example that we'll talk about a little bit later as well, which will be a bearish trade within the technology space. But you kind of even got that impression before tonight's after hours activity that the NASDAQ is struggling more than the others. Notice that the NASDAQ was only able to get to its resistance point back here on October 5th. Remember, we talked about how the other indices were able to get easily up and over it. So like if I were to switch this to the Dow Jones, look at how different that looks. The Dow Jones passed its resistance point from early October over here on October 18th already, right? That was 9 days ago. So the Dow has just been kind of adding to its strength along the way and easily broken through that level. In fact, this morning it got darn close to breaking this high over here, and I would not have guessed that ahead of time. I could envision them taking this high out here, but I would not have guessed that the Dow would have gone as quickly as it did to this prior resistance point back here on the 12th of September. Because remember, it was that next day where the markets just collapsed. That was, there was some big, Fed announcement or comments out of Jerome Powell that happened that day where we were feeling pretty good, riding high for 4 days in a row, and then it was just a massacre from that point forward. So we are now all the way back to there. If you were invested in the Dow Jones types of stocks, and some of you who follow me as dividend growth investors as an example, your portfolio is probably a little bit more aligned with the Dow than it is with, let's say, the NASDAQ or the Russell or even the S&P 500. So some of you, if you're lucky enough, you might find that your portfolio is actually back value-wise to where it was back here on September 12th. And, had you asked me that just a couple of weeks ago, whether that would have been possible, I would have laughed at you. I'd have said, no way. But this has been a really strong move there for the Dow. And again, compare that to the NASDAQ. The NASDAQ just let alone getting back to over here. Here's the same view on the NASDAQ. This is like 12,240 on the NASDAQ. And look at how far away we are today on the NASDAQ from that level. And then I switch it again back to the Dow, and we're basically tied with that level on the Dow. So that's another way to identify that you can hope and wish that the tech companies were doing well if that's the way that your portfolio was positioned. But there is no denying that the Dow is easily the leadership group right now compared to those tech stocks out there. The market is a little bit more comfortable with those, not the pie in the sky ideas right now. They feel a little bit more comfortable with the blue chips, the companies that actually make money, and they might not be the most exciting places in the world, but the market is appreciating their cash flows and dividend yields and all that good stuff that you typically find in the Dow right now, and it's a little bit standoffish against a lot of those NASDAQ components. And remember, that's basically 180 degrees different from what has happened largely in the last decade or so. This has been a decade that's been dominated by mega cap tech, the whole FANG phenomenon that people talked about endlessly for years. And this kind of feels like we're in the midst of that unwind that's taking place right now. And remember, if you look back throughout history and look at the major market meltdowns and the major economic concerns over the years, what you typically find is that there is a new crop of leadership that emerges. And so it's going to be interesting to see who replaces the FANGs in the next cycle. Will it be healthcare companies? Maybe there's companies that defeat Alzheimer's or kill cancer or whatever it is. Maybe they'll be the leadership in the future. Maybe industrials will. Maybe financials will. But right now, it's looking like the old leadership of FANG is a wounded creature, and it's going to have a harder time becoming that leader of the future once again. So it's an interesting moment, to say the least, that we find ourselves in here this week, especially with all of those earnings announcements. So again, as it stands, 3 out of the 4 charts do still retain their strongly bullish postures. The NASDAQ is the odd man out. They're only weekly bullish, and they are going to be threatened with very quickly going to strongly bearish if they cannot find any recovery here in the next couple of trading days. And you'll also notice the NASDAQ composite is the only index where it is trading back below its falling 30-day moving average. All these other indices are above their moving averages. The Dow is actually above its rising moving average, which is why that line is green. With the S&P 500 and the Russell 2000, their price is above a falling moving average still. And the NASDAQ, clearly the laggard here, is back below its falling 30-day moving average, which is why it's red. So this is kind of a good educational moment here as well, because a lot of times you see the indices kind of track one another, and so it's kind of hard to decipher small differences in the charts. But right now we actually have all 3 of the possible color schemes existing on the 30-day moving average: yellow, red, and green, so that way it helps those of you that aren't as familiar with our chart setup kind of interpret that a little bit easier. Instead of having all 4 of them green or all 4 of them red, this is a rare time where we have all 3 of the various colors there, telling us that there's a little bit more separation taking place in the market. It's more of a stock pickers market as opposed to just a liquidity driven type of a market that's taking place right now. All right, let's go ahead and step away to the internet. I always like to get a chance to say thank you to those of you that help support these market outlook presentations. And the last time I did the video on Tuesday, you guys stepped up as you typically do, and I certainly appreciate that. As you know, I try to get these videos out as soon as possible after I record them, so that way you guys on the East Coast have a chance to watch them before you go to bed. And my hope is that by getting them out a little bit earlier, I can garner up and gather up a few more likes along the way, and you guys rarely let me down. So thank you to the 114 people that clicked like for me on Tuesday. As I always say, as long as we're up and over 100 likes, it makes it seem to me at least that it's worth our 3 hours that we put of effort into doing these videos for you guys. The lower amount of likes, then of course there's probably less motivation for us to do the videos because we don't really get paid to do them, right? We try to do this as a spirit of goodwill to give you some education along the way, and also to try to get the name out about our business of Market Scholars, where we do make money off of the subscriptions that we have for our premium members. And we will be doing our annual Black Friday sale next month. So if you're kind of on the verge of maybe signing up for education for the next 3 years, then hopefully that will be a good amount of savings for you here in just a month or so. But thank you to everybody who did go ahead and click like for me. Thank you to Michelle and David and Susan and Thomas and Violina and Jim and Norm and Paul and Rich, Meredith and Michael and Victoria, David, Edward, Jim, Claire, Joel, Ram, Robbie, Chris, Teddy, Wayne, Barry, Richie, Lucius, Valerie, Sheila, Brian. Can't go through all of you, but I do like to give some shout outs here and there just to let you know, hey, I recognize you. I appreciate you. Please keep that up. As long as you're up and over 100 likes, again, the next time I'm scheduled to do the video next Tuesday, I'll be happy to give you another full-length video just like I'm giving you right now with a trade application example. But if you prefer the shorter format, I can certainly understand that as well, and that's no sweat off my back. If you guys would like a smaller, shorter video, then don't click like. And if we're under 100 likes, then I'll just do a 15-minute version of the market outlook video that concentrates only on the 4 major U.S. equity indices, and we don't have to go through all the 12 grid analysis and all of the trade applications and all that kind of stuff. So we kind of let you guys decide collectively there. If you want to support the presentation, easiest and best way for you to do that is simply to click like for us there on Twitter. Also, let's have a chat here about the factor selector. And this gets put together on Tuesday night, but it is based on Tuesday's closing price information. Usually I do not emphasize that aspect of it, but considering the wild and crazy activity that we're seeing in the after hours sessions here, a reminder that as of Tuesday's close, we did not yet hear from Microsoft, Alphabet, Meta, Amazon, and Apple. So a lot has happened in just the last 48 hours, which could have an impact on some of the movements that we're seeing here. But once again, we do see that momentum is leading the way on the factor selector. It is the 4th straight week that momentum has led this market. And as I was mentioning to the swing trading class yesterday, momentum right now has the benefit of having a lot of oil and gas companies in it. And in at least one of the cases of those momentum funds that we track, they only update their portfolios twice a year. And we're about to embark upon that once again, that ticker symbol MTUM from BlackRock. I believe they do their rebalancings in November and in May. And, there's probably not going to be a lot of swapping out of the oil companies in this upcoming rebalancing because they have remained hot, just like they were back in May. They've continued to be hot here 6 months later. But where there will be some swapping out potentially is with something like the utilities. Back in May, the utilities were, a relatively strong category. And fast forward to today, and we've been talking about how that interest rate sensitivity has been catching up with them. So some of the utilities might be swapped out for things like, industrials and financials and things like that. So we'll all find that out together. But for this moment in time, momentum is carrying the torch of this market largely because it has a lot of oil and gas exposure. On the bottom side of the graphic, low volatility fell quite precipitously. And again, utilities would be a good example category of stock that would fit the low volatility factor. And with interest rates seemingly surging day after day after day, of course, we've had a little difference there this week, but largely we are in this significant uptrend in interest rates that is having some damaging effects on things that are traditionally low volatility, like utility stocks, like REITs and other interest rate sensitive areas. So that's somewhat new to see them at the bottom, whereas it's kind of the same old up at the top with momentum. And you can see on this lower graphic down below here, that it's kind of a mixed bag on the 1 month category between the blue values and the green momentum. So it's kind of a tug of war on that time period. But momentum is beating value on the 3 month and 6 month categories. Remember, there's an impact of all 3 of those time periods that goes into the overall graphic rankings up above. For those of you that are premium members of Market Scholars, remember you find this information by hovering your mouse over Tools and then clicking on Factor Selector right there. Also, earlier today, I taught my question and answer session, so I had a good time talking about dividend stocks and all that kind of good stuff with our premium members earlier today. And then David taught his portfolio management with ETFs class. So feel free to check out those recordings if you're a premium member and you weren't able to attend those classes live. Tomorrow, David will be back in action with his technical analysis class. Make sure you check that out, and then later on tomorrow afternoon I'll get the updates for the stock selector and sector selector done. So lots of good stuff coming your way as always here at Market Scholars. All right, let's go ahead and jump back on over here now to the main charts, and let's do some 12 grid analysis. And I wanted to kind of swing by, shake the routine up just a little bit here and bring up some ratio charts. This is chart 5Q. So this is not usually the first 12 grid that I start with, but I found it to be an interesting day to at least kind of pop in and gather some information here on occasion. And this chart 5Q is designed to compare one ETF or entity to another. And the way that you kind of read this is look at the labels in each of these 12 charts, and whatever is listed first before the slash, so like for instance, let's just use commodities / bonds in this kind of brown colored label up here towards the top. This ratio chart is basically going to go in the direction of the first one listed. So like when you compare one price to another, you get a sense of where direction is heading. And so what this is telling us is that commodities right now are stronger than bonds. Now there's been a little bit of a stall out here in the last week or so, but in general, we've been starting in the lower left and ending in the upper right. And I think that is probably pretty obvious. Most of us know that bonds have had a really tough go of things for the most part in the last few months because interest rates have kept on going up, whereas commodities haven't been damaged that much. So right now, that's more of an inflationary type of environment that we find ourselves in, with commodities outperforming bonds. Others that are interesting is over here in the upper right, in the purple area, emerging market stocks are really getting trounced by the developed foreign stocks, right? And I've kind of been sharing that information with you in the traditional 12 grid that I usually show you. But this is kind of a different way to actually come to terms with that, because you're actually looking at those two things ratioed or divided into one another. So this is quite dramatic, right? That is a plunge that is taking place there with those purple bars. And a big reason behind that is what's been going on in China. I mentioned here, last week or whenever it was, that day when Alibaba was just getting smoked, and a lot of other Chinese, especially internet companies, were going down with them. Whereas over in Europe and other parts of the world, it's not nearly as bad as some of those emerging markets. Others that are kind of interesting right now, U.S. stocks versus foreign stocks. In the gray or silver, however you want to say it here, off to the right-hand side in the middle rung, you can see that U.S. stocks are still largely outperforming foreign stocks because you've got that upward tilt to that chart there. But a lot of that is driven by the dollar. And remember what we talked about in Tuesday's presentation, where the dollar started to kind of spill over a little bit. So we don't know where that's going to take us, but it is interesting to note that it was about 4 trading sessions ago where the U.S. stocks were outperforming foreign stocks at their greatest amount. But for the last 4 days, we've actually seen a give back in that relationship. And it's probably because the dollar has started to weaken. So we're kind of back to almost a support level on the ratio chart here. If you believe in the concept of old resistance becomes new support. So maybe this is a place where you start stabilizing again. But that's one thing we want to keep our eye on, because if the dollar does start rolling over in a big way moving forward, it's possible we start seeing a few more breakouts in the foreign world, right? We talked about in the presentation on Tuesday with the trade application example, Brazil, but that's just one example. We might start seeing a lot more. I know like Turkey's chart has really broken out as well. That's more of a currency play there, but nonetheless, sometimes we get so fixated on what's happening here in our own country, we forget there's a lot of investments outside of the United States as well that might be worthy of taking a look at if we start seeing those charts stabilizing a little bit more. And likely what will cause that is a weakening US dollar. So let's prepare ourselves for that eventuality. On the bottom rung, this one's also an interesting one in the lower left-hand corner. Notice the green chart is basically starting in the upper left and ending in the lower right. And in that case, it's basically telling us that growth stocks are getting trounced by value stocks. And that's another way of basically saying that the Dow is crushing the NASDAQ right now, right? Those two concepts are effectively one and the same. Growth stocks are oftentimes represented by stocks in the NASDAQ. Value stocks are oftentimes represented by stocks in the Dow. They're not perfectly aligned in all cases, but in general, the theme it generally holds true. So when we're in a moment in time like this, where the Dow seems to be superior to the other indices, it's another way of saying value stocks are finally starting to outperform growth stocks. And whether that trend continues or not is anybody's guess, because as I mentioned previously, if you look back over the last decade plus, the growth stocks have really crushed the value stocks. But we happen to be in one of those opposite environments right now where market participants feel more comfortable in the blue chips. You'll also notice here that discretionary stocks are struggling versus consumer staples. And that's not a great thing for the market risk appetite. Generally, you want to see the opposite. It's kind of telling you the same thing as this ratio over here with growth versus value. If you're in a really strong economy with a really hot stock market, you typically would find that this pink chart would be starting in the lower left and going to the upper right, because discretionary stocks would be easily outperforming boring old consumer staples. Right now, you're seeing the opposite of that as well. And again, another way to kind of think about what's happening at a high level with the NASDAQ and the Dow. And then also wanted to point out over here, the equal weight S&P 500 versus the market cap weight S&P 500 in the orange here. Notice that we're all the way up here in the upper right corner. And what that's telling us is effectively what we saw today on the heat map, which is we actually had more stocks in the S&P 500 close in the green than in the red, yet the overall S&P 500 closed easily in the red. So this is a way to kind of determine, is it the generals that are leading the market, or is it the foot soldiers that are leading the market? And right now, it is the foot soldiers that are seemingly leading this market. So that is also quite interesting to kind of peruse as we go through these ratio charts right here. One thing that's maybe a little bit surprising is in the blue off in the lower right-hand corner here, small caps are really kind of slipping here versus mega caps. And it might not be overly obvious when you just look at like the Russell versus the Dow, because both of them are outperforming the NASDAQ and the S&P 500. But here you can more clearly see that the Dow is the leader more obviously, even over the small caps universe. Because again, small caps, if they were leading the mega caps, then the chart would be going from the lower left to the upper right. But since the small caps are the first one in the ratio there, it basically shows you that they're underperforming the mega caps here. So all of this is to say that we are in the midst of a market that has felt more resilient here this week, which we all, I think, appreciate. But the other thing that we're learning about the market right now is that this is a market that is drifting towards where it perceives safety, with value stocks over growth stocks, with mega cap blue chips over speculative tech, and with bigger companies over the small caps. And that's another sign of risk appetite, in addition to the things I mentioned about the equal weight and discretionary versus staples. All of them are kind of telling us the same thing, which is the market is drifting towards some of the more mundane blue chip businesses and is kind of getting scared by tech right now, which is pretty much the exact opposite of how the stock market has felt over the last decade. So we are certainly living in interesting times. Let's go ahead and take a look at some other 12 grid analysis with our traditional chart 5A here. And as you can see, in the lower corners, so in the lower left-hand corner we have the dollar, in the lower right-hand corner we've got the U.S. Treasury yield. They're both pink charts now. And those two have really set the tone for the rest of the market all year long. So that's why we usually start our conversation with those two here when I do this portion of the presentation. With the dollar, it's legitimately breaking down, right? We talked about that yesterday in my factor-based swing trading class as well. But this was a pretty healthy move lower on the dollar, where you had 3 out of 4 days in a row, or three out of 4 days to the downside, and each one of the down days was a pretty nasty down day, where you closed near the lows of the session. And in doing so, at yesterday's close on UUP, so remember this is the US dollar versus a basket of other securities, but it's mostly the euro. The euro is the biggest component of that basket. But anyway, yesterday, we closed below this candle over here that would have been looked at as a support candle on October 4th. So that was very interesting. We did have a snapback in the dollar today, so we'll see. Maybe it was just a head fake. Sometimes that happens. Sometimes people put their stop losses below obvious levels. Market makers take it down there, disappoint everybody who has weak hands, and then rip it back the other direction. So we shall see. But this has been such an aggressive move here. I think there's a decent chance that you could actually see a little bit more prolonged dollar weakness here, with that concept of, hey, we are now quite a bit below that moving average. There's a little bit of an air pocket there where it would need to have quite a bit of energy to get us back above that moving average. So there's maybe a little bit more hope here that the US dollar maybe just kind of, jump the shark, as they say, with the old Happy Days and Fonzie, right? Where you just get a little bit too hot and then it's over, right? We've seen the dollar go up and up and up and up and up all year long. Maybe, just maybe, it went too far. Maybe, just maybe, we need to settle things out a little bit here. And maybe we have a bit of time where the dollar's in the penalty box, or at least just going sideways. It doesn't even have to go down. I think the concern from market participants is that it was just keeping on going up without ever getting checked. Right now, it's getting checked in a pretty big way. I'm not necessarily willing to go on record saying that about treasury yields yet. And a lot of times they have gone hand in hand. So, with any bit of luck, maybe we'll see that here soon enough on treasury yields. But I'm just not willing to get that bearish in my mindset with the 10-year treasury yield, because it remains above that rising moving average. And you can even see the background color of the chart is light pink as opposed to the dark pink on the dollar. So to me, it's clear that the dollar has suffered real damage. With the 10-year treasury yield, it's just kind of like, a little bit of a scratch to the surface. It's not really like the car got into a big accident yet. But could we get there? Sure. We've had 4 out of the last 5 days with treasury yields going lower. We now see the treasury yield under 4%. And, that was a concerning level. It's a big round number and one that a lot of people pay attention to. So I think this is a good sign in general. And that's part of the reason probably why you are seeing those Dow stocks do a little bit better there as well, because many of them are those dividend paying types of companies. And when treasury yields go up, there is an alternative to dividend stocks. When treasury yields go down, then that concept kind of reverses, and market participants are willing to go back into, those bigger blue chip types of companies out there, because there's a lot of them out there that pay 4 and 5% dividend yields. I was mentioning that to my dividend class on Tuesday, that from what I can tell, this will be the highest average yielding portfolio that we are in the midst of putting together right now that we've ever put together in all of my dividend classes. And I'm not just talking about the 10 that we've put together here at Market Scholars. I'm talking about all those dividend portfolios I put together with many of you at TD Ameritrade. That was pretty funny what David posted to Twitter today with TD Ameritrade's chart when we started with them and when we left them. And of course, he was just joking, but nonetheless, we got in at a low and then we got out at a high, apparently. Of course, these days, Ameritrade stock doesn't even exist because it got bought out by Schwab, but that's neither here nor there. But the point is, I've put together a lot of dividend portfolios since I've become an educator in this business. And I'm nearly certain that the one we are in the midst of putting together right now will be the highest yielding one. And remember, I'm not usually intentionally looking for the highest yields. Of more importance to me is the quality level of the business. But just because of the way that the stock market has fallen so violently this year, combined with a lot of companies raising their dividends, and combined with that concept of investors in general always comparing dividend stocks to treasury yields, this is quite a high yielding portfolio we are in the midst of putting together right now, probably somewhere in the 4.5% to 5% dividend yield range. So, it's been really interesting to watch how things have shaken out this year from such a variety of angles. So 4% level is an important one, and it is good to see here that we did slip below 4%. We get back above 4%, then all of a sudden, even some of those big blue chip companies are not going to look quite as appealing as they have here in the last week or so. So, it's above that rising moving average. If it breaches it to the downside and starts giving us this type of behavior like we're seeing with the dollar over here, then I'll start getting a little bit more bearish. But until then, I kind of have to assume that the trends will hold. And eventually, of course, that won't be the case. Every trend does eventually change, but a lot of times people jump the gun on claiming the end of a trend as well, and I don't want to be that guy. So I have to assume that this trend will hold. If it doesn't, I'll be happy to reverse course and change my mindset about it. But right now, let's at least be thankful for 4 out of the last 5 days, Treasury yields finally going down. And remember what I mentioned to you guys on Tuesday. I don't think it's a coincidence that we happen to be in a blackout period for or a quiet period for the Fed right now. I think that if the Fed was not in a quiet period right now, I think that they would have already come out on record and tried to stomp out the bullishness of the stock market. But because they're in a quiet period, we haven't seen them come out and try to squash the market. And that basically is another way of saying if they were going to try to squash the market, what they would be doing is talking tough, talking very hawkishly about how they're going to continue to raise interest rates. So this has kind of been like a sigh of relief for the Treasury market, where you haven't had the Fed and their governors coming out ad nauseum, basically saying we're going to keep on raising rates from here to kingdom come, right? Because that's kind of the signal that they've been sending earlier this year. But since they're in a quiet period right now, this is a rare time where Treasury yields have fallen, bond prices have gone up. Notice TLT was up yet again here today. And the stock market has allowed itself to go higher during this time period. But all that can change next week, right? We're going to start hearing from the Fed again. That quiet period will be over. And since it just so happens to be coinciding at a point where the Treasury yield is close to that rising moving average, which could act as support, I, for one, would not be surprised at all if we see rising Treasury yields starting next week when we start hearing from the Fed again. So prepare yourself for that possibility there. Let's talk about some other charts here. Oil had a nice day. Oil was up another percent, and that's their third day in a row to the upside. And I kind of like the way that their chart is shaping up here, because before this last week with oil, you could have gotten away, like if I were just to zoom in to this area, you could have gotten away with saying that looks like it's a downtrend that's starting to form on oil, where you've got a high, a lower high, and a lower high, and you've got all of these lower lows as well. But fortunately, the last week kind of changed that trajectory to a degree, where your assumption when it came down to this moving average would be it would eventually plot another lower low. Instead, it has reversed course and is giving us at least some hope that we're getting a little bit of a bounce here. Now remember, depending upon who you are, that might not be the right phrase to use because some of you are not hoping that. Remember, higher oil prices actually tend to lead to more inflation. But if you are somebody who believes in oil being a risk-on asset, that's a good thing. And certainly if you're somebody who owns a bunch of oil stocks in your portfolio, that's also probably a good thing there as well. Whereas you don't really see that same type of behavior here out of gold. Gold is looking quite a bit more negative in my view at this moment than oil does. And you're seeing that gold is having a hard time staying above its 30-day moving average here. Notice the line is red versus the line is green over here for oil. So oil above its rising moving average, gold remains below its falling moving average and looks like it's kind of struggling at that level right now, similar to what I said about the NASDAQ composite. So not a great look there for gold, but we shall see. You just never know when a geopolitical news event could impact something like gold. Also, it's going to have a little bit of sensitivity to what's happening with the U.S. dollar, right? And so with the dollar falling over the last week, gold has been rising, but today the dollar snapped back, and today gold fell back down. So there's going to be a lot of hemming and hawing about what's going on with currencies as well when you're thinking about what might be the future for gold. I also wanted to point out that high-yield bonds once again continue to impress, and I specifically pointed this out with you guys on Tuesday, and I'm just going to reiterate it here again on Thursday because it's done nothing but continue to go up. And I personally view that as a positive sign because of these three different bond categories, high-yield bonds versus foreign bonds versus long-term U.S. government treasuries, it's the high-yield bonds that's probably the best way to measure risk appetite. And when the high-yield bond market is moving higher, it's a way of saying that the market right now is willing to give sketchier corporations the benefit of the doubt that they're not going to default on their bonds. And that's usually a more risk-on concept for the broader markets more generally as well. Now, also keep in mind what I've mentioned to you guys countless times in the last couple of years in the relationship of high-yield bonds and oil. Because a lot of oil companies were truly on the brink of disaster just about 4 or 5 years ago when oil prices were really low. There's a lot of corporations in the United States, oil corporations, that raise that high yield debt. And so you do have a little bit more of a correlation in this current moment in time with high yield bonds and oil prices generally. When oil prices are up, it gives the market the impression that those sketchier oil companies will survive. When oil prices are down, then the market gets concerned about the possible default on their debt. So I think that's kind of helping in this case here as well. But either way you slice it, and whatever the reason is, it's a good look. It's a good look for high-yield bonds right now to clear their prior resistance point. We've talked about that with the stock market, right? The S&P 500 up and over its resistance point from October 4th. But even some bond categories are doing the same thing here with the corporate bonds in the high-yield area. So, another somewhat positive sign there. As always, we're trying to figure out the weight of the evidence. And as I mentioned before, I'm still more on the leery side of this market rally, but I'm still open-minded enough and flexible in my thinking to change my mind if I need to. But right now, I just wonder if we have collectively seen the benefit of the Fed quiet period allowing for risk assets to go up, whereas otherwise they would not have in other conditions. So I want to hear from the Fed next week before making a major market call here, there, or otherwise. In terms of looking at the chart 5C, the U.S. sectors, it was kind of a mixed bag today. No surprise that it was communications that led the way lower. Remember, that's where Meta is. So when Meta is down 25% and it's one of the most important companies in that sector, you're going to see a lot more damage done there. So we are back to strongly bearish posture on communications. It is the only chart that has the pink background color. In terms of who the best performer was today, let's see, it would have been probably industrials. And going back to the heat map that I was sharing with you earlier, that makes sense to me there as well with, You know, all of those defense contracting companies doing so nicely today, in addition to a nice stock like Caterpillar helping out there. So otherwise, pretty much same view as what we were looking at here the other day. Let's get into our trade application example now. And for that, I'm just going to pull up our swing trading chart 3A, and we're going to pull up ticker symbol ZS. This is Zscaler, probably not a name that is all that familiar to all of you out there. It has been a very good growth stock in the last, let's call it 3 or 4 years, but is not a familiar name like the FANG stocks that are out there. Nonetheless, this one kind of caught my eye today as being one that I might want to float a bearish trade on. And I think, you know, that is helpful for you guys to kind of get into the back of my mindset as well. Remember, 1 week ago, when the stock market was down, I was willing to fade the stock market by doing a bullish trade by selling a put on the utility ETF. Remember, it had that oversold cluster signal that day. Tuesday, when I was lit with you just 2 days ago, I was saying how my mindset was still more negative, but we didn't actually see the technical evidence on the chart to take a bearish trade yet. So I resorted instead to doing a neutral trade with that iron condor on Brazil. And now fast forward to today, where I'm starting to see a little bit more damage done, especially on the tech-heavy NASDAQ, where I'm willing to do a bearish trade again. So we kind of did the full cycle. Bullish trade, neutral trade, today back to a bearish trade, as the NASDAQ seems to be suffering with a lot of these earnings misses from those tech stocks. So Zscaler is one that kind of caught my eye today simply because it went back to a bearish near-term posture. Notice the background color of the chart is pink, whereas a couple days ago it was blue. So it had a nice rally here on the 25th, but then yesterday it really faded that. It attempted to get up and over those highs early in the session, but then closed near the lows of the day. And even today, when it was a nice bounce back day of up 1.8%, where its industry had some positive elements because there was I think it was a Twitter hack that took place, and this one's more on the security software side of the equation. It benefited from that, but even still, it was not able to get to where it was trading 2 days ago, so it remained with that bearish posture there with that blue line rolling over. In addition to that, you can see we've got a bit of a bearish divergence signal where prices were going up at a time when this blue near-term line had lower highs along the way. You see that it's still trading below its falling 30-day moving average here as well. And so what I opted to do in this case was to sell a bear call spread for the month of November, and I sold the 170 call and I bought the 175. I collected a credit of $1.14, which means it was a 30% return on risk, and this blue line that you see up here represents my break even on that trade. And as you can see, as long as this stock continues to trade below the moving average, I should be good to go. And even if it does break above it, I've got quite a bit of wiggle room there. As long as it doesn't break this set of lower highs, I think I'm in pretty good shape with this one. Again, we're concentrating on November, so it would not be the December time period where you might get a little bit more bullishness into the holidays. So, you know, we'll see how it shakes out, but I felt like today I saw enough evidence on the NASDAQ during the normal session, even before seeing what's happening with Amazon after hours, to place a bearish trade once again and kind of balance out some of those deltas. Remember, as one of the perks that you guys get as premium members of Market Scholars, you guys get to learn what trades David and I will be doing on the video early, because we send out our trade notifications and screenshots and all of that during the normal market session, and then you learn about our analysis of that trade while you watch the video later that night. So that's another key benefit. If tomorrow the NASDAQ gets hammered right out of the gate because Amazon's down so much, this stock will likely be down as well. So that could have been a very valuable piece of information for you to learn today while the market was open. Now, you could say that I just got lucky, and that might very well be the case as well, because sometimes it will work the opposite way. But I always like to highlight where, yeah, at least you have the ability to consider the trade if you're a premium member and get that information in your hands a lot sooner than everybody else. So yet another reason to consider signing up for Market Scholars, especially next month when we do our Black Friday sale. All right, so that will do it for tonight. I hope you enjoyed the presentation. It's been such an interesting week here with all of these earnings announcements. I felt like going through those ratio charts with you guys tonight was an effective way to help kind of nail down in the back of your minds what kind of a market we are dabbling in right now. But critically, we have to remember that we are in a quiet period for the Fed. We will start hearing from them next week, so we could have a pretty major temperature change in the market. So buckle up. It could be a bumpy ride, and if it is, then having some of these bearish trades could be effective in our portfolios as well. If you got value out of tonight's presentation, I'd encourage you to click like for me there on Twitter. As I mentioned before, as long as we're up and over 100 likes, I'll be happy to do another full-length video for you the next time I'm scheduled to do it on Tuesday. If we're under 100 likes, then I'll just plan on doing a 15-minute version with no trade application example. So we'll let you guys decide collectively. Regardless of what you decide on that count, I appreciate you checking out tonight's video, and I'm sure David will be back with you here tomorrow night to kind of wrap up the week, and then I'll see you guys all at some point next Tuesday. So with that, all the best of success with your trades and your investments. Goodbye for now.